Hello, money and banking students. We now only have 3 weeks left, so good job, everyone. Just keep plugging along. Great job with the forum discussion. We're going to continue that this week, along with your homework problems, and you'll read chapters 16, 17, and 18 to give an overview of your reading this week and what we'll be thinking about. Chapter 16 first talks about securities and investment banks and security firms, but kind of distinguish between the two. One, think of it as one that does more like engaging in the buying and selling, especially in the secondary market, and investment companies being ones that, or investment banks, I should say, one being that issues the IPOs. Actually, the debt market is probably the largest IPO that's issued every day with these types of firms, but it doesn't get as much attention. It's usually the stocks that we see in the news with the IPOs, but it's a way in which companies raise capital, that is the money they need for their projects. So there are firms that engage in both of these, but a lot of this chapter goes through a lot about how that process works. And then when you get to towards the end of the chapter, it's kind of interesting too, is kind of the regulation and a lot of the laws that have evolved, because there have been many abuses over the years, especially with firms that wanted to raise capital, and they were telling the investment banks that, well, you need to say good things about me, and steering people into securities that they wouldn't even invest in themselves. So that's what hopefully a lot of the correction was, especially after the subprime crisis. You'll read a lot about that history. When you get to the next chapter, you start to look at mutual funds and to kind of help you understand the differences between all the different types of funds. They start off with the load fund, which I am not a fan of. You even look at the book and the direction. To me, today, it makes no sense to pay such a high sales commission up front. And a lot of the load funds, if you were to take in the sales charge, you'd actually do worse off in your returns. There's plenty of choices out there that you can invest in that don't have a load up front and will give you just as good as a return, if not better. So you're going to continue to, I think, see these on decline as investors, just every day, consumers start to understand better about how the financial markets work. And then with that, you're going to understand how to calculate net asset value on a mutual fund, and also get into a little bit of understanding about hedge funds too. The last chapter, we look at that. We think about that with the chapter 18 that you're going to look at this week, and it kind of looks at the pension funds. A lot of us have some type of pension, usually through our work, or we may choose to be part of a retirement plan through an IRA. We can do that individually, but there's the defined benefit, which a lot of government agencies, like I work for the state of Missouri, so I'm part of a PURES program. I think it's maybe the 45th in rank and size of all assets, of all the defined benefit funds out there. So I contribute a certain amount. My employer contributes a certain amount, and based on the years of service, they will pay me an annuity amount after I retire, set payment based on that, some formula. I think the formula is like average monthly salary times 1.61% times number of years of service. So, and a lot of the government agencies these days, though, they kind of, especially in areas like Detroit and Michigan and other places, overpromised on these pension funds, and that's where they're coming into a lot of trouble. But most employers these days are going to things that are called defined contribution. There's like a 401k or 403b, where you make the choices. We'll provide a financial advisor through the different funds. They will recommend some choices based on your strategies, but we are not guaranteed anything. So it's all up to your investment choices. But they usually contribute some match to a dollar amount. That's a benefit. In fact, that's a thing you should consider when you're thinking about benefits that an employer is paying. I know some companies recently, they had to go down from 5% to 2.5% on their contribution, and that impacts your bottom line. So when you're taking a job, you need to think about what other additional benefits, not just salary, are they paying. And again, this ties back to the previous chapter, because most of these defined contribution funds plans have ties back to mutual funds that you can choose. A lot with the defined benefit, they're usually managed by someone within the state or the organization that goes out and makes special deals with, like, purchasing equities that get a lower cost, and they have to get a return that is greater what their contributions are into the fund. and their payouts. So just similar like insurance companies, they have to have sure they have enough coming in with those that are currently contributing and the money going out and their returns, and hopefully they do well enough. And sometimes they have to adjust how much you have to contribute each year in order to maintain that payout. So, all right, well, do email me via the course if you have any questions, but otherwise have a great week. And a little bit lighter this week, but remember the following week you have that project, so start working on it now, and I'll talk to you online. Take care.